Back in January of 2024, I made an update video to my original video on Greencoat UK Wind about how I keep buying shares of the company. The share price has since dropped just under 30%, having also been down as much as 34% since when I last made my video, helped by a recent increase in the past few weeks. Along with the share price declining, so has the net asset value. This has decreased from 160 pence per share down to 134, representing a decrease of 16%. As this decrease is much less than the decrease in the share price, this means that the discount at which the shares are trading has widened further, which I will touch more on shortly. So, what's changed in the past 2 and a bit years? First, a quick overview. UKW owns and operates wind farms across the UK. This is up to 49 now from the 46 back in 2023. They provide a growing dividend, which is the main source of investor returns. The dividend is now 10.7p, which is up 22% from 3 years ago, and its forward dividend yield is around 10%. They continue to reinvest excess cash flow to increase the portfolio's value. Lastly, their market value has dropped from 3.41 billion to 2.35 billion. Quite a significant drop in market cap. So what are some of the causes of this? Well, there's been quite a few external factors affecting UKW. One surprisingly is a new Labour government. Despite wanting to make Britain a clean energy superpower, they have implemented changes that quite negatively impact clean energy generators, which in turn could lead to less investment. One of the major changes was how legacy contracts, known as renewable obligations or RO, are priced. RO is essentially a fixed price that UKW is paid per unit of electricity it generates. Previously, the RO contracts were increased by the retail price index each year. However, back in October 2025, the government proposed 2 potential changes to these contracts. The first was to switch the yearly increases from RPI to CPI. Both of these are measures of inflation, so it might not sound like much, but CPI is consistently lower and therefore would result in lower increases each year. UKW estimated this would remove 2.5 pence from their net asset value. The second option was by far worst. This proposed freezing the current prices paid on the contracts until the rate of inflation measured by CPI catches up with RPI, as if it had always been inflated with CPI, not RPI. Once caught up, CPI would then be used going forward. Based on the estimates, this would likely cause prices to be fixed until 2035. This would be pretty awful for UKW and other clean energy producers. UKW increase their dividend each year by inflation. They are able to do this because a large amount of their revenue comes from these contracts, which could now be frozen. After the government proposed these changes, the share prices of the 6 largest renewable funds fell 5% and £400 million of market cap was lost. Following this, there was a large amount of pushback from these companies, highlighting how retrospective revisions to contracts will erode investor confidence. This decreased confidence would increase the cost of capital for future renewable energy projects, and investors would be aware of the additional risks that the government could change contracts in the future. They argued that this would in fact increase consumer bills, not decrease them, and I think I have to agree. UKW said this change would decrease their net asset value by 10.6 pence. Now following this, the government decided to go with option 1 of swapping RPI for CPI, although the much lesser of 2 evils, still a large hit to the company's net asset value and investor confidence. Unfortunately, this isn't the only change. The government have also committed to removing carbon price support in 2028. This was a tax on electricity generated from fossil fuels. Essentially, it added to the cost of generating electricity for fossil fuels. UKW are obviously not directly affected due to not generating electricity from fossil fuels, but as this has been removed, it now makes it cheaper to generate electricity from fossil fuels. This has a knock-on effect of reducing future energy prices, leading to UKW reducing their net asset value by 2.1 pence in the March 2026 update. Again, not the only other change. They have also committed to increasing the windfall tax from 45% to 55%. This will be effective from July 1st this year. This applies to companies selling power above £82.61 per megawatt hour. Back in 2023, they paid an additional £40 million in tax under this windfall tax. This was due to the price spike shortly after Russia invaded Ukraine. Despite this increase, the company does not expect to pay any of this going forward, as the rate is currently above power price forecasts. However, this does mean they would benefit less from future spikes in prices. So, some quite negative actions coming from a supposedly green political party. These changes have of course reduced the net asset value as mentioned. However, I believe the harm to investor confidence is worse, and this can be seen in an even widening discount to its share price. So it sounds like it was a bad investment and maybe time to cut losses. Despite all the headwinds, the share price has stabilised over the past 6 months, with it now up 11% since February. Greencoat have just released their half-year results, and I'm going to briefly look at some positives from it. Firstly, the wind was a bit more windy. Stating the obvious, more wind means more power, higher generation, and therefore more cash generated. This is actually a nice change, as for quite a few of the past earning reports, average wind speeds kept being below their averages. So it's nice to see higher generation, albeit completely uncontrollable. Next is a return to net asset value growth. This is very important. As we saw earlier, it has been declining for the past 2 years. I find these graphs really helpful to understand what has had an impact on the net asset value. All prices are in pence per share. As we can see, it has increased from 133.5 to 134.1. Not a massive change, but nice to see. So in the last 6 months, they generated 10.3p from cash, which gets added to the net asset value. Then immediately the dividends get taken off. So 5.3p was removed. Depreciation of assets is also taken off, and then some assumptions are adjusted each time to give a final NAV. This includes an increase in expected power prices and inflation. Higher prices and higher inflation increase cash generated. However, these are normally pretty well offset by an increase in discount rates or interest rates. This would be less of an issue if the company had lower levels of debt, but debt is currently 42% of their asset value, which is pretty high. Looking a bit more into their debt, their current weighted average interest rate is 5.1%, with some of their debt as high as 7.3%, or some as low as 2.6%. Although the total level of debt may be decreasing, I imagine the rate they are paying moving forward will start to creep up, as newer loans will likely be at a higher rate than the ones fixed a few years ago. Moving on, as we've spoken about before, higher energy prices are a great benefit to Greencoat, but also, if they start to drop, this could cause concerns on the sustainability of the dividend. As we can see in the graph, they are fairly stable over the next 30 years. As we can see in the table, the dividends will be sustainable unless power prices fall below £30 per megawatt hour. With this being nearly half the forecasted price, I would say we are fairly safe from this happening. The last thing I want to touch on is their forecast over the next 5 years. Here shows how much cash they expect to generate and how much will be paid out in dividends. The amounts here aren't important until we see that they expect to have somewhere from £800 million to £1.3 billion in excess cash flow. So in addition to getting a 10% yielding dividend, there is a potential for more investor return. This can come in the form of bonus dividends, share buybacks which will increase the share price, a reduction in debt or the purchase of new assets, both aiming to increase the overall net asset value. Now there is so much that can happen in the next 5 years. I don't think anyone was really expecting what happened in the past 5 years, with a new Labour government winning a landslide victory and making actions that have negatively impacted the green energy generators. However, it is currently looking fairly bright for Greencoat UK Wind and other renewable investment trusts. The question is, can they deliver? Only time will tell, but I will be keeping a closer eye on the company and will release some more updates along the way. Thanks for watching.